My name is Alex Lindstrom. I am a senior integrated marketing communications major, and I've been in Dr. Husney's magazine program for the last 2 years, and so it's been awesome to get to come to this and listen to all of y'all speak. So without further ado, it is my pleasure to welcome up Mr. Reed Phillips, and today he will be talking about how to add value to your brand, and he is the CEO and managing partner for Desilva+Phillips. So let's give him a welcome. You're welcome.
Well, thank you very much, and I wanted to thank Samir for having me back. A couple of years ago, I was on this stage having a discussion with my friend Jim Elliott, and Jim's going to be here speaking in about an hour, so you're going to hear from him as well. First, I thought I'd tell you a little bit about my background. I'm an investment banker specializing in media and in particular in the magazine industry. And I have been an investment banker for 26 years, but before that, I was a magazine publisher, and that's how I started my career. When I was in college, I would go to the library every month to look for my favorite magazine at the time, the Washington Monthly, which was a political journal that was kind of quirky and had a relatively small circulation, about 30,000, based in Washington, D.C. And every month I was looking forward to the magazine coming in at the school library, would read it, and then decided to apply for an internship. When I did apply, I was lucky enough that they had a full-time job, and I got hired and worked there for a year, and then worked in magazine publishing after that at the New Republic, where I was associate publisher. Was there for 5.5 years, and then worked on some magazine startups. So I have a magazine background before becoming an investment banker. And today I'm going to talk a little bit about how, if you're selling your magazine, how you can add value to the brand before you sell it. And some of what you're going to hear are challenges in the current industry to being in a position to sell your magazine. The good news is that after I give my presentation, you're going to hear from some real experts. You're going to hear from John French, who has a lot of experience creating value for B2B magazines. And then you're going to hear Jim Elliott's panel, and they're going to talk about what they're doing also to create value. So you're going to hear some really good live world examples. Let's see. Let me see. Maybe I just click on the, is it easier just to click? Ah, okay. This is what I'm going to cover today. I'm going to give you just a very quick overview of my firm. I co-founded the firm 21 years ago, and then we're going to talk about the new M&A reality, mergers and acquisitions reality for magazines, then get right into adding value before you sell, and then talk a little bit about conclusions. Just quickly on my firm, we've completed 300 transactions valued at $11 billion. We're specialists in media, marketing, technology, data and information, and most of our deals are in the range of 15 million to 150 million. This is our team. We've got 27 professionals all together. And this is just some of the experience we've had since 2004 in consumer magazines. We've sold Parade magazine on behalf of Condé Nast. That was a deal that I led. Parade was the largest circulation magazine in the US, reaching 32 million households. We sold that to Athlon Media Group. They were the #3 player in the space. Parade is a Sunday insert that goes in newspapers. The #2 player was USA Weekend. Athlon Media Group was the #3 player, and they ended up buying the business and consolidating and becoming the #1 player. We sold a online restaurant review based in the Netherlands, Eins, to TripAdvisor. And then we also sold TV Guide magazine, the 15th largest U.S. Magazine with a circulation of 1.8 million. Again, to another industry player, NTVB Media, and they specialized in producing TV listings for newspapers and would have those inserted in newspapers. Their objective in buying TV Guide was to combine the two and then sell advertising, the 1.8 million insert from TV Guide and the 1.1 million they had in newspapers, so that they would have almost 3 million in circulation. This is not particularly good news at this conference, but I need to kind of walk you through it. Magazines are not worth what they once were worth, and I'm going to explain why. The high watermark for magazines was between 1985 and 2007. Since then, there's been a steady decline. That's due to competition from internet brands. And a lot of it really started with the recession of 2008, and the businesses stopped performing as well as they had been performing previously. I have 3 examples here for you. Business Week sold to Bloomberg in 2009 for about $5 million. 10 years earlier, the owner of Business Week rejected an offer for $1 billion. So it kind of shows just how much that business lost in value in a 10-year period. Now, the magazines that have been most affected immediately by the impact of the internet are news weeklies. So if you look at magazines like Newsweek and U.S. News, they're essentially out of business now. Time magazines is the remaining news weekly. Same thing with Business Week and other weekly publications. Second example is Time Inc. When I started my career, Time Inc. was the gold standard in the magazine industry. That's where everybody wanted to work. It's for a long time been the company that's had the greatest value in the magazine industry. Just to show you how much things have changed, Time Inc. right now has a market cap of about $3.2 billion and is currently for sale. And the interest is relatively low among buyers. So if you've been following that, they've been saying for probably a couple of months that it was imminent on when they were going to kind of select a buyer and move forward. That's still not happening. What's really interesting is that Vice Media is now worth more than Time Inc. Vice is worth $4 billion based on an investment they recently took from Walt Disney and from the Hearst Corporation about a year ago. And then a third example is Active Interest Media. They just recently were for sale. They ended up, they're a company that combined magazine publishing with events, and they had a number of other activities in the company, and they did a really good job of organizing the company for sale. But when they went to market, no one was interested in buying the magazine part of the business. In fact, the best deal was for someone just to buy the events business. So they were left with the magazine business. They had to separate the events business and sell that to a buyer that was primarily interested in events. And these are the reasons that that magazines have lost value. First of all, the main reason is the sharp decline from interest by buyers. We think of buyers in 2 sets. We think of buyers as strategic buyers, and those are companies that already have media assets and typically already have magazines that they own. So they're generally in a better position to be acquiring another magazine because they're going to have synergies, and they can save costs, and they can, in the end, ultimately pay more for the business than what we call financial buyers, and financial buyers don't have any of that. They just have money available to spend in acquiring businesses. The strategic buyers, are in a position right now where they're reluctant to acquire more magazines. That's been the fact for about the last 10 years. So when we go out to sell a magazine company, we do go to the strategic buyers. We do go, I went to Time Inc. with both Ebony magazine, which is one of the leading African-American magazines. They own Essence magazine. And I went to Time Inc. with TV Guide, and they own Entertainment Weekly, one of the other leading entertainment magazines. And even at Time Inc., there was no interest in taking the titles and combining them and being kind of the #1 player in each of those categories. Regardless of what the price was, Time Inc. was really set on only buying digital businesses right now. So media companies, magazine companies, right now we find are trading at about 4 to 6 times EBITDA. That's the earnings before interest, taxes, depreciation, and amortization. That compares to about 8 to 10 times 10 years ago. So it's about half where it was. Most other media businesses are trading today 8 to 10 times, or maybe even higher if they're digital media businesses. The only other ones trading in this range are print newspapers and book publishing companies. Media companies also are reluctant to hold magazine companies within their businesses, and we saw that when Time Warner spun off Time Inc. The reason for the spinoff was that it was a drag on the valuation of Time Warner. So Time Warner as an entertainment company would be valued north of 10 times EBITDA, but if the magazine business was only valued at 5 times, it's pulling down the overall valuation in the public market, so they spun it off, and and as a result, the Time Warner valuation went up. And then what we're finding now is that when we go to sell a magazine business, the interested buyers tend to be among media companies, newspapers. They need to diversify outside of newspapers, so they're very interested in magazines. And relatively recently, the Tribune Publishing Company, which has renamed itself Tronc, made an offer to buy Us magazine, came close to buying it for $100 million, backed away, and it was bought by another magazine publishing company, American Media. What was interesting was Tronc was attracted to that acquisition because it was at 4 times EBITDA. So I guess with the synergies, they were going to get about $25 million in EBITDA, and Tronc itself, as a public company, is trading around 4 or 5 times EBITDA. So that's an acquisition they could do that would be accretive. Financial investors also are less interested in magazine publishing than they once were. And that's because many of them made big investments in the industry, and then when the recession came in 2008, a lot of those companies, if not, I should say most of those companies, went through bankruptcy. And as a result, that left a bad taste in the mouths of investors. And they became very, very reluctant to go back in and invest in B2B magazines or consumer magazines. As a result, they're skeptical of ad revenues. They see how during the recession the ad revenues dropped by 30%, and when that happened they couldn't drop their cost structure fast enough to maintain EBITDA at the level that they needed to for their bank covenants. So when I talk to financial investors now and we pitch them on a magazine company, like I did not too long ago with a well-known investor in Chicago, they would say, well, look, that's all very good, but I can buy a software company for about 10 times EBITDA, or data centers, and they have very predictable revenue because it's all sold on a subscription. So every month I know what the revenue is going to be. It's highly predictable, and they have renewal rates. It's like what we do with subscriptions in the magazine industry, but they don't have the risk of the volatility of advertising. And so for a financial investor, those kinds of characteristics are very attractive. So as a result, it's more difficult in my job to sell magazine companies. But when we do go to market to sell magazines, we suggest that the company dress the business up before sale, spend about a year doing so. This is not unique to the magazine industry. This is what any seller would do. If they own a manufacturing business, they're going to want to fix that up before they go to market. It's like you would do when you're selling your house. You would, fix it up as much as you can. It may look better than when you lived in it, but your objective is to get the higher sales price. And then the second thing, and this is the hard part, is the thing to do now to get better value if you're selling a magazine is to look less like a magazine business. And that may seem counterintuitive, but that's the way to go if you want to attract a high value. The other option is to really come up with a different kind of a model for a magazine business. And I do have a client now I'm working with, and they are a magazine business that is formed on a very, very new model. They're very successful. Their EBITDA last year was about $4 million. This year it's going to about $15 million. And they've got a model that is terrific and one that I've never seen before. The only thing that's going to hold us back on valuation is some buyers are going to say, but wait a minute, it's a magazine business. But we're still, it does show that there are ways to create a lot of value still in the magazine world. As I mentioned, here's the house example, the before and after. These are some of the things that we focus on when we're selling a business. Add backs are something where you're maybe spending money one time in 1 year, like you're moving your company. We'll take that out of the financials and add it back to the bottom line because that's a one-time event. Owners tend to take a lot of money out, especially in small companies, through the business. We'll add that back, so it's added back to profits. And then if you have an audit for your business, that's the gold standard, but most of the smaller independent magazine companies typically do not have audits. On the legal side, we'll look at corporate structure. It makes a difference if you're an LLC or a C Corp when you sell because of the tax consequences. So you want to be an LLC. If you're a C Corp, you have 2 levels of taxation when you sell. You have to pay the taxes at the company level and then at the personal level. So you want to try to avoid that. Buyers want to know if your contracts, whether they're with vendors or clients, are transferable. They also want to know if you have any litigation. And if you do, that could be a problem in making the sale actually happen, and there may be some sort of a carve-out where the litigation, stays with you post-sale. On the ownership, it's very important before you go out to sell the company to make sure the owners are in alignment. We've had cases where we've been hired by a private equity owner, they're the financial owners of the business, and the CEO running the company actually, it turned out, was not in favor of selling. And the private equity firm made the mistake of saying to the CEO a number of times, you're the greatest. If we don't find the right buyer that you like, we're not going to sell. And we're just happy to continue to own the company. Well, the CEO took all that in. When we went down the road with the sales process, he didn't really like the buyer that we brought forward. And he, at a very critical stage, changed the projections for the company and said the company was not going to perform as well as originally expected. Well, the buyer, when that happens, 99 times out of 100, the buyer says, well, then I'm not going to pay you as much as I was going to pay you. And when that happened, the private equity owner said, well, wait a minute, the business shouldn't be worth less than it was yesterday just because our projections changed. But in fact, it is worth less. So in the end, the private equity firm did not go forward with that sale. It turned out 2 months later that the numbers that the CEO was projecting were met originally. And so he was really kind of making it difficult to to sell the company. And the private equity firm continued to own the business, sold it about a year later for about half as much as the price that they had at that time. So that's why it's important for the owners to be in alignment. And management team, a critical issue is, is the management team staying on post-transaction? A lot of times when someone buys a business, they don't want to have to figure out how to run it on their own. They want the current management team to continue to run it for them. And so that's a critical issue. You should, if you're the owner and you have managers, you should make sure they're locked in by contracts and will stay with the company post-transaction. A couple more things, look and feel. It's a good time to redesign magazines and refresh websites, even improve the appearances of the office. And then in positioning, ask yourself what makes your business unique and what makes it less vulnerable to competition. Those are the really critical questions you need to answer when you're selling your business. You need to, for the buyers to understand the answers to those questions. And I think, when you heard last night the Hoffman family talk about their business, they did a good job of giving you kind of insight into what makes their business very unique. And then on the advisor side, as an investment banker, I have to recommend that you get expert help from investment bankers and lawyers. And the reason is that what you're going to find is a lot of these advisors have done deals just like your deal. You may think your deal is really unique, but you might find if you talk to me, I've sold 5 companies that were just like the company that you currently own. And so there's a huge advantage when you work with an investment banker, whether it's me or somebody else who sold a company just like yours. They know what the issues are, they know who the buyers are, they know what the approximate value is going to be, so there aren't going to be any surprises. A lot of times we do see owners, sometimes owners can, I would say 1 out of 10 times when an owner sells a business on his own, he does extremely well, better than he would have done if he'd hired an investment banker, and it just works out that way. But most of the time, you don't do as well, and it's partly because, of course, the buyer's objective is the opposite of yours as the seller. The buyer's objective is to buy the business as cheaply as possible and to get as much as they can in the transaction, not to give you as much money as possible. And when I said earlier, look less like a magazine, these are some of the things I was talking about. What you want to do with buyers is give them what they're looking for. And they're looking for businesses that are less dependent on advertising. And they're looking for you to show that you've developed product lines with your magazine business that help offset some of the declines you may be seeing on the magazine side. And then also, they like to see that you've been able to create new businesses from your magazine and your relationships that you already have with your readers and advertisers. And then second, think differently about how you position your magazine. Your magazine probably should not be the main attraction in your sale. It's a spoke on the wheel, no longer the hub. That's a quote from Skip Zimbalist, who was the CEO at Active Interest Media, the company I talked about a little earlier. And Tony Silber is the one who gave me that quote, so I'll credit Tony for that one. And here's a quick case study. I mentioned Vice Media earlier. They actually started as a magazine business in 1994, but now today they describe themselves as a digital media and broadcasting company. And they're partially owned by Time Warner, Disney, Hearst. They have a joint venture with Rogers Communications in Canada and an alliance with The Guardian in the UK. And they've expanded their business to 50 countries. And when you can see the product lines here, they've really diversified the business away from magazines. They have 13 digital channels. They have Viceland TV. They have an HBO series now. And then they've developed Vice Music, Vice Films, Vice Books. They even have an in-house ad agency. And then finally, of course, they do still have magazines. But these guys have created a very valuable company and are a very good example of how to do that. In conclusion, as I said earlier, you want to dress your business up for sale. The reason you want to do that is if you don't do it, the buyer is going to capture that value. So if there's something you can do that maybe adds $1 million in purchase price, if you do it and you do it the right way before you sell, you get the $1 million. If you don't do it, well, the buyer's going to come in, they're going to fix the problem or do whatever it needs to be done, and they're going to create the value. And then, as I said, magazines are often no longer the main attraction, so being solely dependent on a magazine for creating value today is risky. Owners who diversify their product lines beyond just magazine revenues are going to see enhanced valuations. And then finally, be more like Vice, push the limits when it comes to experimenting with business models, form alliances, go global, you know, do things like that. And I may have just do I have a couple minutes for questions, Samir? Okay. So that's my presentation. If anybody has any questions, I think they're just a couple of minutes. And then, as I said, you're going to hear some very good discussions coming up right behind mine on people that have actually created value. So, yes?
The magazine isn't the hub. What is?
Well, I think we saw it last night in, I think it was Susan's presentation, where she said the customer and the consumer should be at the hub. So. Okay, well, oh, yes.
Last night we heard there were several hundred new magazines, 200-300 new magazines launched last year. Why would anybody launch a magazine? Why wouldn't the shows?
Well, it's because I live this every day, and I have for the last 26 years, and I follow the market, and I know what happens. People starting magazines don't know. They're following their passion, and they come up with an idea, and they aren't doing it necessarily for economic reasons. They're initially they're hoping maybe to be able to sell the company at some point in the future, but the challenges in doing so are bigger today than they were, 10 years ago. But that's part of the reason I'm making my remarks, just to really make sure people understand the challenges. And then the next two panels are going to talk more about how to overcome those challenges. Okay.
Thank you.